Good morning, everyone. I've been requested to talk about markets and its sideways movements for the last maybe 7 years. No, sometimes it's very frustrating when markets typically just go up and down a particular range. And so the title of our presentation today is really riding sideways up the highways. And typically, a lot of people really, feel a lot of frustration when markets just move up and down without really any direction, no? Particularly an upward direction. And sometimes they give up on markets before it actually rises. And so our presentation today is really going to talk about what to do in sideways markets and what to look forward to. So if you look at it, the Philippine stock market has mostly been sideways over the past 25 years. Typically, when we say sideways market, it just really moves within a particular range, no? So out of 25 years, if you look at the graph in front of all of us, there's probably about 18 years spent moving sideways. In December of 1994 and up to 1997, prior to the Asian financial crisis, the Philippine stock market was moving within a range of 2,000 to 3,400. Thereafter, amidst the Asian financial crisis, and until 2005, I would say, that's a period of about 8.5 years, we've seen the market trade between 1,000 and 2,000. And then most recently, a lot of people have always asked me, when will the markets go up again? Can 9,000 be possible all over? And for the last 7 years or so, from 2013 up to today, except for a few episodes, the market has been range bound between 6,000 and 8,000. So sideways markets are more of a commonality, no, in the Philippine case. And as I've said earlier, over the past 25 years, 18 years out of that would have been spent on sideways markets. So what drives sideways markets? Really, it's typically a play between the fundamentals of the economy and the market and the emotions around it. So I would always be reminded of a topic that we discussed in the School of Economics way back when I was taking my master's. And it was a topic called the market for lemons. It's really the market for second-hand cars. Typically, when we are faced with the opportunity to buy a second-hand car, if it is of quality, and we are very certain about the quality of that second-hand car, we typically pay the money that is being asked for or the price that is being asked for, and sometimes much more if there is competition for that second-hand car. In the same way, if we are uncertain about the quality of that car, we typically want to pay less. And in Filipino terms, sabi natin, binabarat natin yung presyo ng kotse. The stock market is essentially more or less the same story. If it has good fundamentals, if it has good story to tell, then investors are more than willing to pay for the market. And if the fundamentals are weak, maybe the economy is slowing down, or maybe earnings growth is not, as robust as people expected it to be, then we typically pay less for the market. So the levels of the market is typically a play between fundamentals and emotions, and that is the reason why we have sideways markets, we have up markets, and we have down markets. So let's take a look at this graph. From 1997 to 2002, let's take, just to take a step back, let's say that the price that we pay for the stock market is the stock market index level. So from 1997 to 2002, we were in the middle of the Asian financial crisis. The banking sector was almost insolvent because a lot of companies were not able to pay their loans. The government was not in any good position to actually generate economic growth because it did not have money. And the private sector was left in shambles in the aftermath of the Asian financial crisis. So it was typically a period of weak fundamentals for the market, but at the same time, very weak sentiment. No one wanted to buy in that kind of market, and therefore the price or the stock market index level fell from more than 3,400 down to the 1,000 level in the year 2002. But it stayed there for quite some time, from 1,000 to 2,000. Why is that so? Because if you look at the graph again, no, from 2002 to 2005, the fundamentals started improving. The government implemented EVAT, more tax collections. We were able to pay down debt, and our debt ratio started to improve. And there was more money for government to spend to pump prime economic growth. And I could say that we had improving fundamentals. But generally, after years in the aftermath of the Asian financial crisis, sentiment remained very weak. Despite good fundamentals, people were not willing to pay for it yet. And that is why the price stayed low and the market remained range bound between 2002 to 2005, below the 2000 level. So in that area of green, no, circled in green, you will see almost 10 years that the Philippine stock market was actually stuck in a range of 1,000 to 2,000 because we either had weak fundamentals and weak pricing for the market, or we had improving fundamentals, but sentiment was lagging and it remained weak and no one wanted to pay good price for the market. Now, moving forward to 2013 to 2019, the market is once again range bound between 6,000 to 8,000 level, except for very few episodes during those years that the market went beyond 8,000 to 9,000 for such a short period of time, and actually went below 6,000 early last year, no, early 2020, because of COVID and the lockdown. But mainly the market was within the range of 6 to 8,000. And why is that so? Because for that full stretch, earnings of companies on a year-on-year basis did not grow as much. And we typically want to pay for earnings in the stock market. Higher company earnings means higher prices for stocks. Why? As an investor, you want to invest in companies that produce more net income. But if year in and year out, the growth in net income is not necessarily very spectacular, at some point in time, you typically get, frustrated a bit, and eventually you want to pay a lower price for the market. Why is that so? Because you are not seeing as much growth in it. And therefore, the markets typically will take its direction from fundamentals, but at the same time, emotions drive the price. The fundamentals might be good, but the sentiment might be weak, and therefore the price does not really rise, no? Much like a second-hand car. The fundamentals or the quality of that second-hand car might be good, but no one wants to pay the price that is the right price for it, and therefore the bidding remains low for it. And it is essentially the same in the market. So the question for a lot of people is really, what do you want to do in markets that are range bound? And I would say a lot of people or traders typically play the bounds of the market. Buy at the range when it is low, within the range when it is low, and sell when it is at the high levels. But that exercise typically takes a lot of effort, experience, and knowledge about markets. So let me show you, the numbers behind switching over the short term. So this is the stock market of the Philippines over the last maybe 5 years, no? Not necessarily the last 5 years, but the stretch from 2013 to 2018, where we started in 2013 with the stock market at 7,400 and ended in 2018 with the stock market at 7,466. Within those 5 years, we saw the market go to 8,700 and fall to as low as 5,900. But again, essentially throughout those 5 years, sticking within the range between 6,000 and 8,000. So for a lot of people, it is frustrating to be holding on to money for 5 years and earn almost nothing. Mid-2013, the stock market was at 7,400. End of 2018, the stock market is at 7,466. If you did not do any switches, then at the end of 5 years, your 10 million will be about 10.07 million. A gain of 70,000 pesos. If you did one switch at the top of the market during this time, in the illustration, it's at 8,764. And at that time, if you bought a switch to cash or money market, then your 10 million will be about 11.8 million pesos because you cashed in your gains at the top of the market. And that is one switch worth 1.8 million pesos. Now, you could actually go and be very perfect about it, but no one really does. No one really, knows where the peaks of the markets are. No one knows where the lows are. You can come in at the lows and switch from money market to an index fund. And at the high points, switch back from index to money market fund. So what if you have the foresight, or the ability to do switches perfectly? What does it actually look like for an investor? If you keep on passing the baton as you run, the yellow highlighted areas are the times that you switch to money market. The blue highlighted areas are the times that you switch back to the index fund. If you had done it perfectly in the period 2013 to 2018, your 10 million will be about 17.2 million pesos. And certainly a lot of people will say that there is value to switching. But again, switching is not necessarily for everyone because as I've said, it takes a lot of experience, it takes a lot of time, and it takes a lot of knowledge about the markets. So to me, in contrast to what people say that investing is a marathon, switching is actually a series of sprints. It takes a very short-term view of markets, come into markets when it is low, go out of markets when it is high. Capital gains is the primary focus of switching, to keep on piling capital gains left and right. But it also involves a lot of stock level analysis. If you are buying the index, there are 30 stocks in it that carries the index higher or carries the index lower. And you would have to be very knowledgeable about how many of those stocks and what weights do they have and whether they can carry the index to higher levels, or the index carriers actually have already run their course, but the index laggers are not big enough to carry the march moving forward. So it takes a lot of knowledge about pricing, about fundamentals, about how far the stocks have run, so on and so forth. And an ordinary investor would somehow, in my mind, be very, very hard pressed, to, be in that day-to-day challenge. because knowing valuations is key. Because if you do not know the valuations of each stock, you don't know whether there is mispricing of such stock. And if you don't know whether there is mispricing of stocks, then it is very hard for you to make decisions to switch or to not switch. One almost has to be in the market on a daily basis to be attuned, no, to brewing emotions, because the emotions typically play, no, a lot in the determination of price movements. And we also have to keep watch of price levels. So to me, switching is a very, very tasking job, no? It is somehow at any point in time, no, demands a lot of focus, demands a lot of energy, knowledge, experience, so on and so forth. And typically switching is for the seasoned investors in the market, not the day-to-day investors. So what is my advice, no, to the day-to-day investors who are trapped in sideways markets? The first thing that I would always tell investors, no, day-to-day, to set the ball rolling, is to actually picture their financial goals, no. So look at this whole puzzle and take pieces of the puzzle that complete the picture for you. A lot of day-to-day investors will typically, on the basis of whispers say, well, I'm going to go on an index fund just because it has the highest returns over long periods of time, so on and so forth. But they do not necessarily know whether the funds that they pick actually fit into the whole picture. And therefore, at the end of the day, they are left with puzzle pieces, but not necessarily forming any picture that brings them to their objective. So to a lot of people, I would always say asset allocation is selecting a combination of funds or assets that get you to your financial goals within the risk that you are willing to take. The investment equation is always two-pronged. One is the search for returns, and secondly, it is all about the risk that you are willing to take in the search for such returns. So what am I talking about? A lot of people are willing to take risk, particularly risk involved in the stock market. When stock markets are rising, they are more than happy to jump into it. They are very, very willing to take on the risk of the stock market because their focus is on the returns, and because markets are high, they are more than willing to jump into the bandwagon. But when the market starts going down and going against that direction that they initially had in mind, their actual ability to bear risk somehow surfaces. In investments, it is your ability to take risk that is more important rather than your willingness to take risk. So before you start any investment plan, set your financial goals, what returns you want to make, and essentially also examine yourself as to the ability or the amount of risk that you are willing to take in. Now, just to concretize that view, or that concept, this is a graph, of 100% allocation to equities on the right-hand side and 100% bonds or bond allocation on the left-hand side. So let's focus on the right-hand side first. 100% equity allocation. The average return over the last 15 years from 2005 to 2020 is 8.5%. The biggest return in 1 year is 72%. And therefore, equities are really a good provider of returns. But in exchange for that, equities also exposes you to the risk of losing, no, or the possibility of losing money as much as 43.8% in 1 year over the last 15 years. So again, equities are a good provider of returns, but exposes you to very big downside risk. So if you look at bonds on the other side, on the left side, no, the average return for bonds over the last 15 years is 5% per year, which is lower than the average for equities of 8.3%. The biggest increase in bond funds in 1 year is 25%, which is only almost one third, no, of the 72% single biggest annual increase in 100% equities. And therefore, you would say that bonds pale in comparison from a returns generation perspective to equities. But what is the importance of bonds in one's portfolio? Bonds do have a lot of stability. Over the last 15 years, the biggest single decline in bonds, no, for 1 year is 9.4%, which is almost only one-fifth of the biggest decline in equities for 1 year of 43.8%. So bonds, while less a provider of returns, is a good provider of stability. And therefore, one's asset allocation enables you to somehow go through a sideways market because you know that you are possibly getting to your goals in the long term without necessarily taking unwanted risk. So asset allocation is really the sweet balance between generating returns with low downside or with more stability. So in essence, you can actually pick very different combinations between bonds and equities as to your goals for returns within the risk that you are willing to take. Now, the other thing that I tell people in sideways markets is really to focus on fundamentals. Because as I've said earlier, over the long run, the fundamentals take over and eventually people will price in solid fundamentals. The fundamentals may not be apparent in the near term, particularly in these COVID times. COVID cases increases in a month. All of a sudden, the fundamentals of the economy and corporate earnings come into question. Inflation rises. All of a sudden, people are expecting lower consumption, which accounts for 75% of our economy, and therefore, again, raises the questions of fundamentals. Third, interest rates spike over the last months because of inflation. And again, it becomes a question, no, for the fundamentals of both the economy and the markets. But one has to go beyond the transitory and look at the permanent. So if the reasons for the market declines or if the reasons for the questions around the market are transitory and eventually will fade away, and it allows you to focus on the fundamentals that it can actually rebound after COVID cases have been solved, after inflation has gone down. Therefore, it gives you enough reason to stay the course, and remain invested in a sideways market, given the possibilities that as sentiments fade and turn into positive sentiments, the markets can effectively recover and rise moving forward. The other thing, no, that I remind investors really is what you see in the market is really the price of a stock. The level of the market is an indication of the accumulated prices of stock, no, in the market. But the price itself is not necessarily the value of each stock. The price may be low, but the value may be high. At one point in time, no, Ayala Land was trading at 8 pesos per share. But we all know, and this was way back, I think, in 2008, but we know that the properties held by Ayala at the time in Makati, in Laguna, so on and so forth, were already valued at more than 20 pesos per share. So the price is low, but the value is high. So certainly in markets like this, where a lot of people want to sell out of the market because of uncertainties, the price is certainly low, but it is worth watching, no? Whether the values are also trending lower. But if it's only the price that is trending lower and the value remains to be the same, then you could say that the market is trading at a discount. And even in a sideways market, therefore, I will continue to hold on because of the thought that the price is not really reflective of the actual value of stocks. And eventually, as the fundamentals begin to surface and sentiments turn positive, then the price approaches value. So remember that, no? Remember that. Now, this one is just really a borrowed, no, table. But what is it essentially saying, no? This is from 2006 to 2020. These are different asset classes all over the world. The ones at the row on top are really the top performer or top funds for each particular year, and the ones below are the worst performers for each particular year. And not to belabor the discussion, no, you will see the colors move around. So, for example, in the case of REITs, no, in 2007, REITs, which is the color red, is at the bottom row. It is the worst performing among the asset classes. But in 2010, 2011, 12, 14, and 15, REITs were the best performing asset classes. So markets and funds go in cycles. The funds that you have today may be the worst performer of the bunch, but then again, as I've said, the economies and markets and funds typically will go in cycles. And as long as the fundamentals are good, there is mispricing in markets and we see more value into it. Eventually, no? This is what we're saying. The markets will value it properly and it will be reflected in fund performance. Now, this is not really a plug, no, of a fund in Sun Life, but it is essentially evidence, no, that asset allocation works and that minimal tweaks in the asset allocation actually creates a lot of magic. So the My Future funds of Sun Life are target date funds. If you wish to retire in 2040, buy a 2040 fund. And hopefully, it performs well, that such by 20 years later, you have enough money either to retire or enough to compensate other sources of income that you have. So the My Future Fund, if you look at it, and if you look at the yellow line here, that is the asset allocation glide path of the My Future Fund. At the start, it has a lot of equities, more than 80% of equity allocation, very close to 90% invested in stocks or equities. And why is that so? Because when you are young, you can take on more risk, and the fund mirrors that. And equities, as we've said, are a good provider of returns. Now, as the fund nears maturity and as you near retirement, the fund actually moves to bonds, more of bonds and less of equities, because bonds are a source of stability. And you don't want your money fluctuating down and up when you are already in retirement. You want to seek a lot of stability with regards to your finances. And so the glide path of the My Future Fund is an asset allocation across the years from your younger years to your retirement years. And there are two gray lines, no? One on top and one at the bottom, and they are called tolerance bands, no? Pag umaakyat ang stock market, the yellow line increases in value and touches the tolerance band on top, and it signals the fund managers to sell when the price of stocks are high. When the markets fall, the yellow line falls and touches the band below, and it signals the fund managers, no, about the possibility of buying more stocks into the portfolio. So there are mechanisms from an asset allocation perspective, and there are mechanisms that tweak that asset allocation, no, depending on where the market levels are. And if you will see, there are no big changes that are involved. So if you look at it from 2008 to 2020, the various My Future funds of Sun Life had produced an average rate of return of 9.3% to 9.4%, no? 9.3 to 9.7% actually. If you want to compare that to 100% equities over the 12-year period from 2008 to 2020, the average rate of return is 9.1%. What is the biggest, no, glaring difference? If you are 100% equities, the average return, as we've mentioned, is 9.1%. The biggest decline in 1 year is 43%. But if you look at the My Future funds, because of those mechanisms, they have been able to produce higher returns with lower downside. The matured My Future Fund 2020 had an annual return of 9.3% and a downside of 11.3%, which is 1/4, no, the 43% that you have in 100% VUL equities. So asset allocations work over the long run. Minor tweaks produce a lot for the clients in terms of returns generation with very minimal downside risk. So this one is just really a slide, no, on what I've been saying earlier, no, with regards to the performance of 100% equities. To the right side, 9.1%. The biggest downside in 1 year is 43%. So it's just really an indication that asset allocation, minor tweaks within your funds actually work over the long run. So this is what I leave you with, no? Investing is a marathon to a brighter life. So first is you really have to commit to a purpose. Invest with an end in mind, no? Much like in a marathon, I would always say, even before I step into the starting line, I know that I have to finish 42 kilometers. That is the goal. And certainly in investing, you have to commit to a purpose, visualize a goal, and write it down, because you have to keep yourself reminding yourself that as long as you are not yet there, the race continues. Know your starting point and your ability to take on risk. You know, I would always tell people sometimes, no, they will say, can I be a millionaire in 2 years' time if I just put in 3,000 pesos on a yearly basis? Certainly, it is unimaginable to be able to do that. So know your starting point so that you can actually set real goals for yourself. Know your ability to take on risk. No? As I've said earlier, it is not only about returns generation, but your ability to take on risk. No? In a race or a marathon, you know, I was always told by my coach, I have 9 candles to burn. If I speed up in the earlier parts of the race, I burn myself out. It is the same with investments. If you run very fast and you take on a lot of risk early on, you might burn yourself and never get to the goal of finishing the race or getting to your financial objective. Invest with a plan. Asset allocation is key, as I've said, no? So every time you want to get to a goal, there is a plan behind it because the plan keeps you very disciplined in your march towards the goal. Same with a marathon, I have a weekly plan with regards to what I need to do so that when I get to the race, I actually am very prepared to do it. So same with investments, you have to have a plan. You have to know your asset allocation because that is your base plan. Fundamentals will drive the market over the long run as long as the fundamentals are good. If the price is low today, the price will eventually catch up with the fundamentals of the market. We mentioned earlier that price is not equal to value, and that is related to point number 4. As long as the fundamentals are good, value will begin to surface. Now, even small changes can make big differences. As we've shown you in the My Future Funds, there is an asset allocation, which is the base plan. We tweak around that base plan, and we've been able to deliver results of higher returns and lower downside risk for clients. The last thing that I leave you with is really quality over quantity. Over time, we may be counting coins they left day in, day out, no? And that's typically the quantity involved in investments. We typically want to see returns every day, but that is not necessarily quality investing, no? Quality investing produces very good results, solid results over a long period of time, and it keeps on being replicated time and time again. So again, thank you to all of you for listening. I hope that you have learned much about sideways markets and how I approach it from a very short-term perspective. To those who are very knowledgeable, switching might be something that you are accustomed to. But for those, who are not necessarily in the markets day in and day out, the real approach to markets is an approach based on fundamentals, based on long-term investing, based on asset allocations. So again, I hope that I had given you part of my knowledge, and I hope that it will be very, very useful for all of you in your investment journey. Thank you, thank you, thank you very much.